Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So we're getting into some really monumental results today, Q3 2025. And our focus, it's not just the big headline numbers, is it? It's more about the strategic shifts, where the company's placing its bets for the future.
Really?
We want to dissect that capital deployment, the acceleration we're seeing in AWS, and also how they're radically reshaping the physical retail side. It feels like this dual investment strategy is really defining things right now.
That really is the core story this quarter. Infrastructure and, well, strategic leverage. You look past the impressive top-line figures, and what stands out is the sheer scale of investment. Data center capacity, power, custom AI silicon.
Right.
It almost overshadows the, frankly, very strong operational success they also had in retail. What we're watching is a company spending massively to lock in its position, to be the indispensable foundation for AI, both in the cloud and, on the street.
Okay, let's ground ourselves first with that top-line snapshot. Revenue came in at $180.2 billion. That's up a very strong 12% year over year. Even better if you strip out foreign exchange.
A very solid number.
But that headline operating income, $17.4 billion, that needs a bit of unpacking, doesn't it? Because the actual sort of operational engine performed much better.
It did. It looked strong, but yeah, the true underlying performance, it was exceptional. If you take out a couple of, let's call them non-recurring items, the real operational income hit $21.7 billion.
$21.7 billion.
Yeah, which was a full $1.2 billion above the high end of their own guidance. That tells you the core business, before these other factors, is running incredibly efficiently. Peak efficiency, really.
So, okay, there's a $4.3 billion gap between the reported number and that, well, frankly, stunning operational figure. Where did that $4.3 billion go? Feels a bit like strategically, clearing the decks.
That's exactly how I'd interpret it strategically. Management used this moment, this peak operational strength, to basically absorb two pretty hefty one-off charges. It's a common tactic, right? You take the hit now so future quarters look clean, starting from a high profit baseline.
Makes sense. So what were the two charges specifically?
Okay, the first was a big one, a $2.5 billion charge. This was tied to an FTC legal settlement. It got booked under other operating expense, specifically in the North America segment. Think of it as a multi-billion-dollar regulatory cleanup cost. It's done, it won't repeat.
Got it. And the second charge, that sounds like it connects more to the restructuring, the headcount changes we're going to talk about later.
Correct. The second hit was $1.8 billion. That was earmarked for estimated severance costs linked to pretty widespread role eliminations. And crucially, this wasn't just one area. It hit all three main segments, North America, International, and AWS. It touched tech roles, sales, admin costs, the lot. So by booking $4.3 billion in these cleanup and restructuring costs in a quarter where they actually beat their own high-end guidance by $1.2 billion operationally, it just shows spectacular underlying financial health. It signals maximum strategic flexibility as they head into the new year.
And that strategic flexibility, you can see it immediately when you look at the infrastructure engine, AWS. Let's pivot there. They're calling it the AWS Renaissance. For a while, the story was all about growth, slowing down, deceleration.
Yeah, that narrative is gone. Completely flipped.
That story is just gone now.
The acceleration is, I think, the single biggest takeaway from this whole report. AWS growth year over year re-accelerated to 20.2%. Now, for listeners, that's not just a nice tick upwards.
No.
It's the highest growth rate AWS has put up in 11 quarters. 11. It's a powerful, really material reversal, and it's almost entirely driven by demand for AI infrastructure.
We really have to emphasize the scale here, though, because AWS growing at 20%, that's fundamentally different from a smaller player hitting, say, 30%.
Oh, absolutely. Different league.
We're talking about applying that 20% growth to an annualized revenue run rate of, what, $132 billion?
Yeah.
Every single percentage point adds billions in actual dollars. It just cements their lead.
And it doesn't look like short-term noise either. It seems locked in. We saw their contract backlog, the future commitments, grow to a massive $200 billion by the end of Q3.
$200 billion.
And get this, management specifically pointed out that this huge figure doesn't even include several major, still unannounced deals they actually signed in October after the quarter closed.
Wow.
The signal couldn't be clearer. Long-term enterprise commitment to AWS infrastructure is just unprecedented right now.
But doesn't that sort of raise a big question? If demand is that overwhelming, future contracts are locked, where's the risk? Is there maybe a danger in committing this much capital expenditure, this massive capex?
That's the absolute central question when you look at how they're deploying capital. The confidence in future revenue is translating into these, well, monumental capacity commitments, especially power and physical data center construction. They're building like they fear a supply crunch, not a demand slump.
Okay, let's talk about the scale of that power investment, because the numbers are kind of mind-boggling.
The scale really does defy easy comparison. AWS reported adding over 3.8 gigawatts GW of power capacity just in the last 12 months.
3.8 gigawatts.
Yeah, I mean, to put that in perspective, that's roughly the sustained output of several large nuclear power plants combined, enough to power a decent-sized American city. And they made a point of saying this is more power capacity than any other cloud provider added in that same period.
And they've given us a pretty clear one-way for this infrastructure push, haven't they? Their stated goal.
They stated it very plainly. AWS is now operating at double the power capacity it had back in 2022. Double. And they're on track to double that massive capacity again by the end of 2027.
Wow.
They expect to bring another whole gigawatt online just in Q4 alone. This isn't just a tech company anymore in that sense. They're strategically acting like one of the world's biggest energy infrastructure developers.
And we know that securing reliable, huge amounts of power is really the main constraint for the whole AI industry right now. Seems to be moving faster than even the chip supply chain issues. AWS looks like they're trying to solve this bottleneck almost single-handedly.
They're definitely anticipating that the power bottleneck is going to stick around for a while, before maybe the constraint shifts back to the chips themselves later on. So this really aggressive power buying, the infrastructure build-out, that's their key differentiator right now. It lets them actually secure and then service those massive $200 billion backlogs.
So what's the best operational sign that this staggering investment is actually justified, that it's not just building empty capacity?
It's the immediate monetization. That's the key indicator. Despite the record speed and scale of adding all this capacity, 3.8 GW, built in just 1 year, the new capacity is getting used almost instantly. If they were overbuilding, you'd expect to see utilization rates drop. But that would hit capital efficiency.
Yeah.
But the fact that this new capacity is running hot tells you the demand is overwhelming, it's non-deferrable, it's demand for AI training and inference, and it's happening right now.
Okay, let's zoom right into the heart of this AI infrastructure, the custom silicon. This is section 1.1 in our notes, and it's really where they're trying to differentiate on performance and, critically, cost. Trainium. It's not just some experiment anymore, is it?
No, not at all. Trainium has fully arrived. It's now officially classified as a multi-billion-dollar business for AWS. And this is critical. It grew 150% quarter over quarter.
150%.
Yeah, I mean, that's hyper growth.
Yeah.
In a highly specialized, very capital-intensive hardware segment, it's huge.
So why are developers choosing to move these massive workloads onto Trainium when they have established options like NVIDIA?
It really boils down to total cost of ownership, TCO. Management is hammering this point. Trainium is delivering 30% to 40% better price performance compared to the other options currently out there.
30 to 40%.
Yeah. And for big companies running AI inference, that's the day-to-day repetitive use of the AI models, those cost savings add up incredibly fast. At cloud scale, price performance dictates market share. It's that simple.
And we can see that scale requirement playing out in this thing called Project Rainier. What exactly is the scope of that partnership? It sounds massive.
Project Rainier is basically the ultimate proof point for Trainium scalability. It's this immense compute cluster physically spanning multiple U.S. data centers. The big name using it is Anthropic.
Right, the AI company.
Exactly. They're deploying their Claude model on a cluster that started with nearly 500,000 Trainium2 chips, 500,000 chips. And it's scheduled to scale up to over 1 million chips by the end of this year.
1 million Trainium chips.
1 million. So this proves it's not just about designing a slightly better chip. It's about having the whole ecosystem, the power, the cooling, the networking, to actually deploy these chips at densities that were, frankly, almost unthinkable just a short while ago.
And the innovation cycle, it doesn't seem to be slowing down there either. What's the roadmap look like for their custom silicon performance?
Yeah, the chip roadmap is aggressive. Trainium 3, they expect to preview that by the end of this year. Fuller volumes should start coming online in early 2026. And the performance target, another 40% performance jump over Trainium 2, which is already very powerful.
With 40%?
So this constant internal iteration and optimization means that even if a competitor launches a slightly better chip on paper today, AWS is already optimizing its entire infrastructure stack for its next generation chip. That helps secure a continuous price performance lead over time.
But they're not going all in just on their own silicon, are they? I mean, sometimes the criticism is they might be pulling away from partners like NVIDIA.
No, they were very explicit that that's not the case. The dual strategy is really core to the whole AWS philosophy. It mirrors how they've always approached things like storage or basic compute.
Right, options.
Exactly. They stressed they maintain deep, growing relationships with NVIDIA, with AMD, with Intel. They even said their purchasing of NVIDIA components is, quote, unconstrained, meaning supply isn't limiting them, and they plan to keep growing that relationship. Custom silicon gives them ultimate optimization for certain things like inference. But customers need choice. AWS aims to offer the broadest selection of all the chip options and infrastructure types. They want to capture every kind of workload.
In this custom silicon strategy, it feeds directly into their big platform offering, Bedrock. What's the ultimate vision for that generative AI platform? It sounds ambitious.
The vision is enormous. Maybe the most aggressive projection they shared this quarter, actually. Management suggested Bedrock could eventually be as big a business for AWS as EC2, the Elastic Compute Cloud, is today.
As big as EC2?
Yeah. I mean, EC2 is the absolute backbone of the entire public cloud industry. If Bedrock gets anywhere near that scale, it implies that consuming these high-level AI services will equal, maybe even exceed, the demand for just raw compute infrastructure.
Yeah.
That points to a huge market shift where AI consumption becomes the primary cloud revenue driver.
And the data they shared shows their custom silicon is already powering that vision, right?
It does. They stated that the majority of Bedrock token usage, basically, the actual work being done by customers using the platform, is already running on Trainium. Already. So that confirms it. The internal chip project and the high-level service platform, they're deeply connected, they're synergistic, and they're driving huge adoption together right now.
Okay, let's transition smoothly now into section 1.2, enabling the agentic future. So we're moving up the stack from the basic infrastructure to the application layer. The thinking here seems to be that the real economic punch from AI is going to come from these agents AI that can automate complex multi-step tasks.
That's exactly right. We're definitely moving past the era of just simple chatbots. An agent is, well, it's a much more sophisticated AI. It's designed to handle tasks that need memory, planning capabilities, and crucially, secure interaction with other systems, external data. AWS is really focused on building the scaffolding, the tools, to let everyone else build these agents safely and effectively.
And they introduced a couple of key tools for developers doing this, Strands and Agent Core. What roles do they play?
Okay, so Strands is interesting because it's open source. It's designed to lower the barrier for actually creating these agents. It makes it easier to build sophisticated agents using any foundation model the developer wants to use. So it promotes flexibility.
Okay.
Agent Core, though, that's the infrastructure piece. That's the building block.
And why is Agent Core so important for big companies, for enterprises?
Enterprises need guardrails. They need assurance. Agents, by definition, need secure, scalable ways to run runtime services. They need reliable memory to handle conversations or tasks that stretch over time. They need observability, ways to see what's happening for debugging. Agent Core provides those essential, non-negotiable infrastructure components. It basically removes a lot of the hesitation companies might have about deploying these powerful agents into sensitive real-world production systems.
And they gave some concrete examples of Agent Core's impact already across different industries. It sounds like adoption is happening pretty fast.
Yeah, the market validation seems really strong. Ericsson, the telecom giant, is using Agent Core to roll out AI agents across its entire workforce, trying to boost internal efficiency. Sony is using it to build an agentic AI platform that has to meet their, very high enterprise security standards. And in healthcare, there's Cohere Health. They're using Agent Core to deploy agents they project will cut down those burdensome medical review times by a really significant 30% to 40%.
30–40%? That's huge in healthcare.
It's massive. The utility translates directly into measurable ROI, real-time savings, which probably explains why they also mention the Agent Core SDK. The developer kit has already been downloaded over 1 million times. That's an explosive start for a new enterprise infrastructure tool.
And AWS isn't just enabling others, they're building their own powerful agents too, right? Agents that drive efficiency and give customers immediate value. Kiro seems like a prime example in the developer world.
Yeah, Kiro is their agentic coding IDE integrated development environment. Basically an AI coding assistant. It helps developers write code, debug it, ship it faster, and the adoption speed they reported was genuinely remarkable.
What were the numbers?
Over 100,000 developers jumped on the preview in just the first few days, and that number has apparently doubled since then. They also said Giro has already processed trillions of tokens of code. That shows developers are integrating AI help directly into their daily workflow immediately and at scale.
And then for bigger companies struggling with older systems, legacy infrastructure, there's Transform. That's an agent focused purely on migration, right?
Transform is all about automating what used to be a really arduous manual chore, moving old code or systems. And the numbers here are pretty striking too. Customers have apparently already used Transform to save 700,000 hours of manual work just year to date.
700,000 hours.
Yeah, think about that. It's like 335 developer years of effort just evaporated. They mentioned Thomson Reuters using it to analyze and transform 1.5 million lines of code per month,
Wow.
helping them move off old Windows systems to open source 4 times faster than they could before. And it's also being used to analyze nearly 1 billion lines of old mainframe code for customers planning cloud migrations. It's a huge accelerator.
So beyond the techies, the developers and migration folks, they're also trying to bring that consumer AI feel into the general business world with something called QuickSuite.
Right. QuickSuite is essentially positioned as an AI analyst or research assistant for, typical white-collar knowledge workers. It's designed to find insights in data, do complex research, automate routine tasks, visualize information, and the results they shared sound pretty transformative for business users.
Like what?
Things like cutting research projects that used to take months down to just days, achieving over 80% time savings on complex analysis tasks, and realizing cost savings of upwards of 90% on some of those activities. These internal agents seem aimed at fundamentally redefining white-collar productivity.
And finally, in this agentic space, there's a really big success story driven by AI adoption. Amazon Connect, their cloud contact center solution. What's making that a billion-dollar annualized revenue business now?
Yeah, Connect just recently crossed that $1 billion annualized run rate milestone, and its success is absolutely tied to its rapid AI integration. In just the last year, they said the platform handled 12 billion minutes of customer interactions that were either augmented by AI or handled entirely by AI.
12 billion minutes.
It's a huge number. And it's being used by massive customer-heavy companies like Capital One, Toyota, Ryanair. It shows that AI is delivering practical, really efficient customer service results at a highest scale. It's basically turning what was traditionally a lower-margin service of the call center into a major high-growth revenue stream for them.
Okay, so this incredibly aggressive, capital-heavy push in the digital world, it has to be supported by massive efficiency and scale in the physical world, too. Let's pivot now to Section 2. Retail transformation, grocery, and operational efficiency. This is where that huge investment in physical logistics meets the customer's demand for, well, instant gratification.
Yeah, the retail segment continues to be laser-focused on those 3 core pillars: selection, low prices, and convenience. And they're trying to back up those claims of continuous improvement with actual data points.
Like selection, for instance. They said it increased by 14% just since last quarter. They're bringing on popular brands like the North Face, Charlotte Tilbury, but it seems the real growth engine is more in the necessities.
That's right. The everyday essentials category, things like cleaning supplies, health products, pet food, consumables. That category is growing nearly twice as fast as the rest of the retail business year to date.
Twice as fast?
Yeah, and that's a really critical signal. It shows customers are increasingly relying on Amazon for those high-frequency, necessary purchases, which ties directly into how they're evolving their most complex piece, the grocery business.
Ah, yes, the grocery strategy. That's always been a challenge, hasn't it? Wrestling with cold chain logistics, last-mile delivery for perishables. What's the big evolution they're highlighting now?
The core of the new strategy is really about integration and speed. It centers on this ability for customers to combine perishable items, fresh produce, meat, dairy, and literally millions of regular Amazon.com non-perishable products into a single shopping cart.
One cart.
One cart for same-day delivery, often in as little as 5 hours. Management explicitly called this a game changer, and you can see why. It eliminates that need to do separate shopping tricks or place separate orders.
And it sounds like they're rolling this capability out pretty aggressively, which suggests the underlying logistics model must be working now.
It's expanding really quickly. This single cart, often 5-hour delivery option, it's now available in over 1,000 cities and towns. And the plan is to reach 2,300 cities by the end of this year. That kind of rapid geographic rollout tells you they have confidence in the efficiency behind it.
But the strategic goal here isn't just selling more bananas, right? It's about platform engagement, and they seem to have data proving that link.
This was maybe the most massive insight on the retail side.
Hmm.
They found that customers who start shopping for fresh groceries end up visiting the Amazon site more often overall, and they return twice as often as customers who only buy non-perishable stuff.
Twice as often.
Yeah. So buying groceries drives engagement, it drives loyalty, it helps transform Amazon from maybe a weekly or monthly shopping stop into potentially a daily habit.
Let's just put the overall grocery business in context again. How big are they in the U.S. market now?
Well, if you lump together their whole grocery operation, that includes Whole Foods Market, Amazon Fresh, this new delivery model, they reached over $100 billion in gross merchandising sales, GMV, in the last 12 months.
$100 billion GMV.
That scale puts them firmly among the top 3 grocers in the U.S. now. And they mentioned Whole Foods Market is continuing on its steady path, plus they're experimenting with new physical formats, like this smaller urban daily shop concept. Only 3 stores launched so far, but they said early results are positive.
So this integrated super fast delivery model, it really does challenge the traditional way people shop for groceries.
It absolutely does. Management seems to be betting heavily that the long-standing tradition of the big, weekly, fixed-day grocery stock-up is changing, and changing fast. And this ability to use that new Add to Delivery button, which they said customers hit over 80 million times since launch, to just tack items onto an existing order, that reinforces the shift towards ultra-convenience, almost impulse-driven, high-frequency grocery top-ups.
Okay, but all of this convenience, it relies on massive investment in the physical infrastructure. Let's look at those operational investments that are designed to actually support this rapid delivery model, especially as they push into smaller towns, rural areas.
Right. This is where a lot of that physical CapEx is going. They specifically mentioned committing over $4 billion just to expand their rural delivery network across the U.S. This feels like a very clear strategic move against competitors who've often found it really hard to make the logistics profitable in less dense small-town America.
So what's the immediate impact been from that $4 billion rural investment? Are we seeing results yet?
So far, they said they've increased the number of rural communities that can get their same-day or next-day delivery service by 60%. 60. They figure they're about halfway to their total goal for expanding rural coverage by the end of the year. This is pretty crucial for maintaining that promise of speed and convenience, no matter where the customer lives.
And beyond just reaching more places, they're also focused on pure efficiency gains within the network they already have.
Yeah.
How are they speeding things up internally?
Yeah, they talked a lot about refining their regionalized network structure, basically getting goods closer to the customer faster. And the efficiency gain they highlighted was pretty substantial. They managed to cut the U.S. inbound lead time, the time it takes for products to get into their system, by nearly 4 days compared to last year.
4 days faster.
For fewer days that a product is just sitting in transit or stuck in a warehouse. That translates into massive savings on working capital, which ultimately helps them keep prices low. It's all connected.
And robotics and automation have to be a huge part of this efficiency engine. We know the number of robots is massive, but what's the strategic thinking behind deploying them at such scale? Is it just about replacing people?
They now have over 1 million robots working in their fulfillment network globally. 1 million. But the strategic philosophy they emphasized is explicitly hybrid. It's not just about replacement. The robots handle the repetitive tasks, the strenuous lifting, sometimes the hazardous jobs. And they say this demonstrably improves safety metrics and boosts overall productivity. But this scale of automation then allows the human employees to focus on more complex things, problem solving, making judgment calls, dealing with exceptions, customer interactions. Basically, the areas where human flexibility and thinking are still most valuable. It's about leveraging robotics so humans can add higher value.
All right, let's shift gears into Section 3. AI and commerce, advertising growth, and these new ventures. So, if AWS is building the foundational AI layer, the commerce side of the business is where AI seems to be generating immediate, really measurable revenue and actually changing how customers buy things.
Yeah, the absolute flagship generative AI tool here is Rufus. That's the AI shopping assistant that's integrated right into the main Amazon store experience. And its scale, and particularly its financial impact, are genuinely surprising.
Okay, what kind of adoption metrics did they share for Rufus?
Get this. Rufus is being actively used by 250 million active customers this year, 250 million customers. Monthly usage is growing 140% year over year, and people aren't just trying it, they're using it more deeply, Interaction depth is up 210%. But here's the killer commercial metric.
Okay.
Customers who use Rufus during a shopping session are 60% more likely to actually complete a purchase.
60% more likely to buy. That is a colossal lift in conversion. Apply that to 250 million customers. That must lead to a pretty staggering financial impact.
It leads to a multi-billion-dollar projection. Management stated quite clearly that Rufus is currently on track to deliver over $10 billion in incremental annualized sales.
$10 billion from one AI feature.
$10 billion. Just from Rufus. That single generative AI assistant is projected to drive revenue that rivals the total revenue of many large established corporations. It's incredible.
How does it actually create that kind of buying leverage? Is it just making search better, or is it doing something more fundamental?
It seems to dramatically lower what you might call the cognitive load barrier, especially when customers aren't exactly sure what they want. They search for something vague like gifts for a toddler who loves dinosaurs.
Right.
Rufus instantly provides these tailored summaries, comparisons, product suggestions, building confidence. By delivering that information superiority and clarity almost instantly, it kind of short-circuits the usual hesitation and research loops in the customer journey.
Yeah.
It makes them much more likely to just pull the trigger on a purchase they suddenly feel well-informed about. And the scale of data Rufus has access to creates this competitive moat that, smaller startup AI shopping assistants just can't possibly match.
And besides Rufus, are there other AI tools they're rapidly rolling out to streamline shopping?
Yeah, they're definitely layering these features in. They mentioned a generative AI audio feature. Basically, it reads out product summaries and reviews. That's expanded to millions of products now. And customers have streamed almost 3 million minutes of that audio content.
Yeah.
And then there's Lens Live. That's their visual search tool. Tens of millions of customers use it every month. You just snap a picture of something you see, and it instantly tries to find matches and tells you if it's in stock. It's all about removing friction, whether that friction is textual, visual, or even auditory.
And that deep integration of customer data, buying behavior, and commerce efficiency, it must translate directly into the rapid acceleration we're seeing in their advertising business.
Absolutely. Advertising revenue is just booming. It hit $17.6 billion in this quarter alone. That's 22% year-over-year growth. And significantly, this is the third consecutive quarter where that growth rate has accelerated. Advertising is clearly in a hyper-growth phase now, and it's a central profit engine for the whole company.
What gives them the edge in advertising compared to, say, the pure-play ad platforms like Google or Meta?
It really comes down to that undisputed full funnel advantage, combined with superior measurement data, because they own the final transaction. They can literally guide advertisers from the very early stages of building brand awareness, using high-profile assets like Prime Video, for example, all the way down to the final point-of-sale conversion through sponsored product placements right there on the shopping page. No other platform really offers that seamless, verified link between seeing an ad and actually clicking buy moments later.
And the growth of their demand-side platform, the DSP, that seems strategically critical too, because it lets them extend their reach and their data intelligence beyond just Amazon.com itself.
Oh, the DSP is a huge game changer for them. It basically leverages their immense first-party customer purchase data to let advertisers target ads across all network of external websites and apps. They highlighted key partnerships, their existing connected TV footprint via Roku, but also new integrations with Netflix, with Spotify.
Spotify, wow.
Yeah, giving access to 400 million monthly ad-supported listeners there. And also SiriusXM, reaching another 160 million digital listeners across services like Pandora. It means advertisers can use Amazon's powerful conversion data to place ads pretty much everywhere the customer consumes digital content now.
Okay, let's look further out now, towards the really long-term vision, agentic commerce. This sounds like where AI moves beyond just helping with search, like Rufus, and into potentially fully automated, trusted agents that might even make purchases for you.
Yeah, the vision here is well, it's audacious. Management actually stated explicitly their belief that AI will eventually make that complex online discovery process.
Yeah.
When you're not sure what you want, comparing options make that experience better and more personalized than actually walking into a physical store and talking to a knowledgeable human salesperson.
Better than a human salesperson. That's a direct challenge to the core value of physical retail, isn't it?
It absolutely is. It's a fundamental challenge.
Now, obviously, they're pursuing this internally with things like Rufus evolving, but did they talk about the potential for third-party agents? Could other companies build agents that facilitate buying on Amazon?
They did acknowledge that possibility, yeah. And they drew a parallel to the early days of search engines. how they became major sources of commerce discovery and referrals. They said they expect to partner with third-party agents eventually, but, and this is a big but, they were very clear that they have extremely high standards for any such partnership.
Okay, so what are the roadblocks right now? What's preventing them from just opening the floodgates to third-party shopping agents today?
The main issue, they say, is that the current customer experience with most third-party agents is often pretty poor. It lacks reliability, sometimes security. Specifically, they pointed out that these agents often fail on personalization, they don't have access to the customer's full shopping history on Amazon,
Yeah.
and critically, they often give incorrect information about things like delivery estimates or pricing. Until those fundamental issues are solved, ensuring the customer experience remains frictionless, accurate, and trustworthy, they're not going to integrate them seamlessly into the core shopping flow.
But the ultimate goal of agentic commerce, it makes sense regardless of who actually builds the winning agent, right? The overall effect.
Absolutely. The fundamental value proposition they see is that AI, and specifically agentic commerce, will dramatically expand the total volume of online shopping. It solves that discovery problem for many purchases. And logically, when the overall pie of online shopping expands, who benefits most? It naturally favors the provider who already has the broadest selection, the best value perception, and crucially, the fastest, most reliable delivery network. Their existing scale acts like a giant firewall.
Okay, finally in this section, let's just quickly touch on the key successes they highlighted in some of their smaller, but still strategically important new ventures.
Right. Live sports seems to be really driving advertiser interest. They mentioned the debut of the NBA on Prime Video averaged 1.25 million viewers here in the U.S. That was a double-digit increase over what the previous season got on traditional cable.
That's significant.
Yeah, and they're clearly expanding here. They're adding golf coverage, the Masters starting in 2026, and a PGA Black Friday skins competition later this year. It signals a serious long-term commitment to acquiring premium sports content.
What about the smarter voice assistant, Alexa Plus One? Is that actually moving the needle on commerce, getting people to buy more?
The enhanced features do seem to be working based on the metrics they shared. Alexa Plus customers apparently talk to Alexa twice as often as users of the classic version, so engagement is up. And critically, they complete 4 times more shopping-related conversations that actually end at a purchase.
4 times more purchases.
Yeah, so it proves that investing in making the AI more conversational, more capable, directly translates into increased commerce conversion through voice.
And those really long-term, maybe higher-risk bets in space and autonomous driving still making progress.
Steady progress, it seems. Project Kuiper, their satellite internet venture, now has over 150 satellites launched. They're achieving speeds over 1 gigabit per second in tests, so it's maintaining progress towards becoming a commercial constellation. And Zoox, their robotaxi company, is actively carrying passengers now in Las Vegas, and they just announced Washington, D.C. as their 8th testing location. So it's a continued, measured expansion of that autonomous mobility bet.
Okay, we've saved probably the most defining sort of macro topic for last, Section 4, capital, culture, and the look ahead. Because this quarter feels defined by spending, by investment. Let's start with the sheer scale of the capital expenditure. It's just massive.
The numbers are genuinely historic, and they really define the period for the company. Cash CapEx was $34.2 billion in Q3 alone. $34.2 billion in 3 months. They've spent $89.9 billion so far this year. And they projected a full-year cashbacks total of $125 billion for 2025. $125 billion. That is spending at a pace that very, very few corporations on Earth could possibly sustain.
And that level of spending, it's not expected to level off next year either, is it?
No, quite the opposite.
Mm.
Management explicitly stated they expect that full-year CapEx number to increase further in 2026.
Increase again.
Increase again. This confirms it. Securing that AI infrastructure advantage, the power, the data centers, the custom chips, and simultaneously refining the global logistics network, these are multi-year, multi-hundred-billion-dollar investment programs.
So as someone analyzing this, how do you view that sustained, even accelerating CapEx?
Yeah.
I mean, obviously it signals incredible confidence, but doesn't it also put significant financial strain on things like free cash flow?
Oh, it absolutely imposes strain, there's no question. But it's clearly viewed as a necessary strategic trade-off. They're effectively choosing to reinvest cash flow immediately right now into building these assets that are incredibly hard, maybe impossible, for others to replicate. The goal is to lock in future competitive advantages.
Right.
The CapEx, as we've discussed, is primarily going towards AWS that AI demand, core cloud services, their custom silicon fabs, and then also continuing to build out and refine the fulfillment and transportation network for retail. They're basically running two enormous, incredibly capital-intensive races at the same time, securing the digital future and perfecting the physical present. The sustainability of it all hinges entirely on whether the projected hypergrowth in AWS, and particularly its margins, can compensate for this massive initial cash outlay.
Which brings us neatly back to that cultural reset piece, connecting directly to the $1.8 billion severance charge we talked about right at the start. We need to explore the why behind those layoffs, according to the company.
Yeah, the CEO's commentary around the headcount philosophy was quite revealing, I thought. The core assertion was that these recent significant cuts were not primarily financially driven, meaning they weren't forced purely by weak profits or needing to cut costs immediately.
Okay.
Nor, they claimed, were they immediately AI-driven, in the sense that AI hadn't suddenly automated all these specific jobs overnight. The argument is that these moves were primarily cultural and structural.
Cultural and structural, what does that actually mean in practical terms for a company this enormous?
It means deliberately removing layers of management and organization that built up during those hypergrowth phases over the last few years.
Yeah.
The massive rapid hiring likely led to increased bureaucracy, slower decision-making, and that kind of inertia can be lethal when the technology landscape, especially AI, is moving this fast.
So the philosophy is trying to get back to a more agile, faster-moving operating model. Is it genuinely possible, though, for a corporation with, what, over 1 million employees now to really operate like the world's largest startup?
Well, that's the stated commitment, and it's undoubtedly the strategic challenge they face. Operating like a startup, as they define it, means being lean, being organizationally flat, pushing ownership down to the frontline decision makers, and just moving faster. Management clearly believes this kind of structural agility is absolutely essential in this current climate of profound technological transformation. They seem willing to absorb that $1.8 billion severance cost as an investment in eliminating decision bottlenecks and streamlining how work gets done. It positions them, theoretically, to better execute that massive $125 billion infrastructure build-out we just discussed. We could almost see the restructuring as a preparatory move, trying to ensure the organization itself can actually keep pace with the sheer speed and scale of the capital deployment.
Well, this has certainly been a monumental quarter to unpack. It reveals a company that isn't just reacting to the AI transformation, but is actively trying to architect it, really, both in the digital infrastructure they're building and in the physical convenience they're delivering every day.
Yeah, the analysis really boils down to that, doesn't it? This stunning confluence of the physical and the digital worlds happening at incredible scale.
Yeah.
They're spending truly vast sums of capital to become almost a utility-like infrastructure provider for the entire AI economy, locking down power, silicon, data center capacity.
Well, at the exact same time, they're optimizing these incredibly intricate, hyper-local physical systems, integrating groceries and regular goods for same-day delivery, rapidly pushing that delivery network into rural areas with dedicated billions in CapEx and leveraging over 1 million robots just in their warehouses.
And the question that scale provokes, I think, for you, for the listener, is this. Given this unprecedented accelerating CapEx commitment and the inherently dual nature of this massive infrastructure investment, digital and physical, how long can this scale-at-all-costs strategy sustain its current incredible pace of growth and reinvention? Will they hit capital limits?
Yeah.
Will they hit execution bottlenecks? The foundation they're laying is clearly immense, but the weight of that ambition is equally immense.
That is indeed the provocative thought for all of us to carry forward. These twin engines, AWS AI infrastructure on one side, and this radical retail transformation driven by convenience and automation on the other, they're both running at an absolute unprecedented speed right now.
Well, thank you for joining us for this analysis of the source material.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.